Blue Book. What is consolidation with acquisition at carrying amount of equity? This refers to a situation where one company, usually a parent company, buys all or most of the equity ownership of another company, subsidiary, using the book value of the subsidiary's net assets. Then, the two companies' financial statements are combined, consolidated, into one. Let's break that down. 1. White heavy checkmark. What is carrying amount, or book value? Carrying amount equals value of the company's assets and liabilities as shown in its books, accounting records. Example. If a company has assets of IDR 1 billion and liabilities of IDR 400 million, its carrying amount of equity is NGINX. Assets less liabilities equals equity. 1 billion less 400 million equals 600 million. So, in this case, the equity's carrying amount is IDR 600 million. 2. What happens in this type of acquisition? The parent company buys the equity of the subsidiary at that carrying amount, e.g., IDR 600 million. This type of transaction usually happens between companies under common control, such as between sister companies, or a parent and its subsidiary. Unlike regular acquisitions where you might pay more than book value and create goodwill, here, no fair value adjustments. No goodwill is recorded. You use the same values already in the subsidiary's books. 3. Link symbol. Why use carrying amount instead of fair value? Because this kind of acquisition often happens within the same group of companies, there is no real economic gain or market transaction. The control of the company doesn't change from the group's point of view. So, to make accounting easier and avoid misleading numbers, the assets, liabilities, and equity are kept at their existing book values. 4. How do you consolidate? Let's say Company A, parent, owns IDR 5 billion in assets. Liabilities, IDR 2 billion. Equity, IDR 3 billion. Company B, subsidiary. Assets, IDR 1 billion. Liabilities, IDR 400 million. Equity, IDR 600 million, carrying amount. Company A buys 100% of Company B's equity for IDR 600 million. 5. Journal entry in Company A's books. Company A buys 100% of Company B's equity for IDR 600 million, which is the book value, carrying amount, of Company B's equity. Journal in the books of Company A. Dr. Investment in Company B, IDR 600 million. Company A is making an investment by buying Company B's equity. This increases A's investment account in the balance sheet. CR, cash, IDR 600 million. Company A pays cash to acquire Company B. So, cash is going out and must be reduced. This journal only affects Company A's own records, not the consolidated financial statements yet. Consolidation entries, adjustment journal during consolidation process. Purpose. When preparing consolidated financial statements, we need to eliminate the investment account from Company A, the equity accounts from Company B. This prevents double counting of assets and equity. Journal elimination of investment against subsidiaries' equity. Dr. Common stock, B, IDR 400 million. This eliminates the common stock, paid in capital, that Company B had on its own books. Dr. Retained earnings, B, IDR 200 million. This eliminates the retained earnings of Company B, because we are consolidating the entire equity of B into A's financials. CR, investment in Company B, IDR 600 million. This eliminates the investment asset that Company A recorded when it bought Company B. This line now has no place in the consolidated balance sheet because we are treating A and B as a single economic entity. These elimination entries do not appear in either A's or B's individual books, they are only made during the consolidation process. 7. When is this method used? This method is commonly used when a company restructures its group structure. Two companies under the same parent company merge. One subsidiary is transferred to another subsidiary. Under IFRS, PSAK, Indonesia, and other accounting standards, these are called business combinations under common control and usually apply the book value method, also known as the pooling of interests method.